made millions of dollars understanding market trends. I want to tackle two things with you, Jason. First is there a looming crisis? Number two, what will be the big trend that comes out of this?
Rick, great question. It's good to be here. The question when it comes to real estate is what type of real estate and where. There are three basic types of real estate markets in the entire world: linear, cyclical, and hybrid markets. The cyclical markets, meaning the expensive markets around the country, South Florida, the west coast of the United States, the expensive northeastern markets, they are in for trouble, especially if they are high-density markets.
Well, this is my very first Jason Hartman conference. I've been listening to his podcasts, and I have been learning a lot there, but already in the past couple hours, I've learned about what more to look for on pro formas. I've already learned quite a bit that I didn't know. And I'm looking forward to learning so much more the rest of this conference so that I can make better investments and make better choices in my investments.
Hi, I'm Jason Hartman, and I want to talk to you about some of the core teachings that have been very popular that I've been talking to the marketplace about for the past 14 years or so. My first set of core content is called the 10 Commandments of Successful Investing. And I created these so that there could be a core outline that you could really quantify and understand. If you understand these 10 commandments as an investor, you will do pretty well. It's not everything, but it's certainly a very, very good foundation. Then several years later, about 10 years ago, I did a second 10 commandments. So there were 20 at that time. And let's talk about one or two of them today for just a few moments. The first one sounds obvious, but let's unpack it a little bit. It is, thou shalt become educated. Thou shalt become educated. You know, education is obviously important. Nobody would deny that. But here's the thing. Education needs to be, number one, it needs to be practical and it needs to be actionable. Number two, it should be either very inexpensive or free. It's an amazing time to be alive, as I always say. And in the world today, information is plentiful and it's usually free. You know, there's an old saying, information wants to be free. Maybe you've heard that. And when it comes to learning how to be a good investor, you do not have to pay someone a fortune to buy their course or get their coaching program. Maybe you pay a little modest amount for good education of someone you already follow and know and like their teachings, and that's fine. But don't pay a lot. So again, practical and actionable, and free or cheap, one or the other. The second of the 10 commandments I want to talk about today is thou shalt have a team, a professional team. Now, you've probably heard people say this or suggest this in one form or another, and certainly having a team of people to help you do anything is beneficial in life, no question about it. But you want to have a team that is actually doing it. I remember one time I was being pitched for about an hour and 15 minutes or so on some guru's coaching program, and this was kind of funny. I asked him during the call. I said, you know, are you a real estate investor? He was pitching a real estate investing program, and I said, are you a real estate investor? You know, how many properties do you own? How much experience do you have? And he, as my potential coach, says to me, hey, look, you know, Tiger Woods has a coach. And he's the world's best golfer. But here's the difference. And I replied with this. I said, look, I agree with you. Everybody needs a coach, even Tiger Woods. But the difference is, Tiger Woods' coach has actually played golf. That's a big difference, right? So the person that is mentoring you or coaching you, or the person you're following and consuming their intellectual property, their content, should have actually played the game, right? Played the game. Hey everybody, welcome. We are live and I've got a couple of great guests with me tonight. Number one from our in-house team, introducing, I don't know if you heard my sound effects, but that's Naresh. Hey Naresh.
Hey, what's up guys? Good evening. Good to be here. Looking forward to talking bubbles and real estate.
Bubbles. And we've got a bubble expert with us tonight. I don't know if he brought any bubbles to blow, like, kids' bubbles. I think that would be a good prop, actually. But Kerry Lutz was actually introduced to me by Naresh many years ago. And he gave a great speech at our Profits in Paradise event in Hawaii almost 2 years ago. And he talked about the history of bubbles. And I thought it was so good and so interesting. There's an old saying, those who don't learn from history are doomed to repeat it, right? And so we want to learn from history, but we're not just going to talk about history. We're going to talk about the past, present, and future of bubbles. And I think there is a lot of reason to believe that we might be in a bubble now. So want to introduce Mr. Kerry Lutz, founder of the Financial Survival Network.
Hey, thank you for that, Jason.
Welcome. How you doing?
We're doing good. And just remember, everything that's old is new again at some point. And bubbles are no exception.
Yeah, well, that's a great point. And, one of the ways that you can really see that human nature hasn't changed much at all is to just read scripture. And you said everything old is new again, and it reminded me of my favorite book in the Bible, Ecclesiastes, where nothing is new under the sun, right? And that was mostly written by the richest person who ever lived, King Solomon, right? So some good stuff there. So let's talk a little bit about this whole bubble mania stuff. I mean, has anybody looked at the stock market lately? Have you looked at especially Tesla? That has got to be.
You're stealing my thunder here.
Yeah, I mean, all of the people who bet against Tesla should be winning now, but they've lost.
Yeah, because that's classic on a bubble. Everyone knows it's going to pop.
Yeah.
But nobody knows when. I mean, back in December of 2017, I wrote an article telling people sell half your Bitcoin. Mm-hmm. Even though we all know Bitcoin's going to infinity, you could still lock in. There were people that made thousands of times their initial investment, hundreds of thousands of times, and they wrote it down to 3,000. Now it's back up, but it was a classic bubble.
Yeah,
and it was obvious. Once I discovered the parabolic chart, I could tell it was a bubble, and I knew it was going to pop. And the longer you hold out, the worse your losses are going to be, or your profits disappear.
Yeah, humans, they really do fall victim to manias over and over again. And no matter how sophisticated someone appears to be, everybody just falls for it. I mean, like really conservative people fall for manias. Really educated people, really dumb people, really, crazy risk takers too. It's just, why is that? What is it about our psychology?
I know exactly why, because I've analyzed it, and I even wrote a article about it entitled "It's the Dopamine Stupid," because we all are driven by, fear and greed, but that isn't really it. We're driven by our brains, and of all the things our brains produce, we like dopamine the best, which is why people become drug addicts, why they drink everything else, why they do certain things, why you become a great golfer and you hit that perfect shot, on the fairway, you get a dopamine hit.
And also, you didn't mention what we're on right now, why you become addicted to social media. It's a dopamine hit too, right?
Yeah, exactly. And they've actually designed it around that premise. So,
which is really scary. And same with gambling, of course, too. Casinos are designed for that big time. Right?
Big time. Yeah. So when you're in a bubble and you see you're making thousands of dollars a day doing absolutely nothing other than you literally bought the right lottery ticket, you're making thousands of dollars a day and you think you're on top of the world, and it's great, and that's what stops you from selling when you should, because you don't want to give up that feeling. But then when the crash comes, there's nothing worse, and people jump out of windows when the crash comes. That old cliche of people, you had to in New York City in 1929, when you were crossing the street, you had to look up for the bodies coming off the buildings there, people who'd lost millions of dollars and just couldn't deal with it.
Yeah, no, there's no question about it. It's absolutely crazy how people keep falling for this. But folks, thank you we got a couple questions coming in. Please post your questions. We'll get to the questions. We really would like this to be super interactive, a lot of Q&A. I'm sure Kerry will be happy to answer questions. Naresh will too, I will. So we will get to those questions. And also, as promised, we will give you a promo code for a discount on our virtual event this weekend, our virtual conference, Meet the Masters of Income Property, with Harry Dent, Sharon Lecter, Ken McElroy, George Gammon. Did I forget anybody? That's the main people. Anyway, I don't know. I probably forgot someone, so I apologize. I'll get back to it. Got a lot of multitasking going on here, folks. Anyway, so that's this weekend. It's our first virtual event, but our 22nd Meet the Masters of Income Property, but the first time virtual. So we're excited about that, and we'll give you a promo code for $100 off toward the end of this broadcast tonight. And Kerry, without further ado, are you ready to roll? I'll share the screen.
Ready. Please do.
And we'll do it. Okay, so let me put this in presenter mode, and you just yell at me when you'd like me to flip the slide if I miss one, okay?
You got it.
Here we go. So first, we're going to talk about the definition of a bubble.
Okay, so what is a bubble? You're always hearing reference made to it. The stock market's in a bubble, Tesla's in a bubble, real estate's in a bubble, federal debt. Wouldn't think about that. That's in a bubble. Currency in circulation. So it's an economic cycle, and it's characterized by rapid increase in prices, and you get what's called a parabolic or exponential move. And you're in a bubble when everybody you talk to is talking about the fact that you're in a bubble. Do you believe the price of Tesla? I could have bought that stock at $10 a share, and it's at 1,800. And so you have a huge spike in asset prices that appear to be unwarranted by the fundamentals of the asset and driven strictly by investor speculation and exuberance. And a lot of people will confuse a Ponzi scheme with a bubble. And they're two very different things. Bubbles often devolve into illegal criminal behavior. Look at the real estate boom that busted in 08 and 09. It was just loaded with fraud. But it started out as a legitimate real estate expansion. And to keep it going and going, to keep that dopamine going, it kept, they just had to create more and more tricks to keep it going. But it was a bubble, and you'll see the chart later. Whereas a Ponzi scheme starts out in illegality, it's a scam, it's a fraud, and it ends that way. So the next one, Jason.
Yep, I'm coming here.
Oh, and I should mention that bubbles are kind of as old as man, but the first recorded bubble goes back to the Dutch tulip mania bubble of 1634 through 1637. And here you see in 1637, one bulb was equal to 10 times a craftsman's annual income. And they didn't make much back then anyway, because, they didn't have internet marketing, so they didn't really buy much stuff. So you didn't need much. You just had to buy food, clothing, and whatever, and you made most of your clothes. You had to buy certain things. Yeah. But 10 times the craftsman's wages. Let's just say the average plumber, average welder makes $80,000 a year without overtime. That means they're making the equivalent of 8 one bulb was worth $800,000.
That's incredible. I mean, you just, we all, Kerry, we all wonder. I'm sure Naresh and everybody watching are thinking the exact same thing. How could people be so crazy? I mean, it's a tulip. I love tulips. They're great looking flowers, but seriously?
Yeah, it is kind of entertaining to watch, but I can tell you that I fell prey to it during the internet stock market boom of the late 90s.
Yep, the first .com boom and bust. Yeah.
Oh man, I just sit in my office and hit refresh. The internet was a lot slower back then, and I would just watch the price of AOL or Cisco go up and up and up for no reason whatsoever, other than there was a lot of people that wanted it because they believed that it could only go up. It's the internet. It's the new thing.
Yeah.
Well, for an example, like one bulb, some of these things I can't even talk about, but it went for 8 fat swine, 12 fat sheep, 2 hogsheads of wine. I don't know what that is. 4 tons of beer, 2 tons of butter, 1,000 pounds of cheese, a complete bed, a suit of clothes, a silver drinking cup, and a bunch of wheat and rye. I mean, like,
I'd rather have all that stuff than the tulip bulb.
but you weren't in the bubble. The dopamine wasn't flowing.
Yeah.
So look at our next slide. This is very instructive because that is what a bubble looks like. Look at that. That was for Gouda tulip bulbs. I don't know what a Gouda tulip bulb is. The solid colored tulips were worth much less than the multicolored tulips. I think that's what that was. But you see that's the classic formation. And then you see that line there. We didn't trace the line off their graph, but that line is straight down, 90% decline, virtually overnight. And you have a whole interesting host of behaviors that take place on the downside. So next one. And so this was, these are usually like decadent societies where these things happen too. So this was the Dutch Golden Age, where they were kind of like a world superpower, but it didn't last very long. Economic depression hit for several years, and the Dutch became very practical, kind of conservative people for hundreds of years till the latter part of the 20th century. But government tried to intervene to support the price of tulips, and of course it failed. So next one, let's see.
Yeah, that's just incredible. So they all wanted a government bailout program, I guess, huh?
Yeah, well, some things never change.
Yeah.
Were
tulip bulbs too big to fail?
Yeah, well, one guy actually ate a tulip bulb because he thought it was an onion, and it was worth like, a fortune, and he was arrested, and the whole mess, because once a tulip bulb is gone, it's gone. So then we go to the South Sea bubble.
Yep.
And another fun time in history, but this is where we go to the next slide. We see that financial sleight of hand really starts to develop, because the whole purpose was England was broke. They had back-breaking war debts. Back then, you didn't have modern monetary theory. This was kind of the beginning of it. So you actually had to pay for stuff.
Yeah, Naresh is chuckling about modern monetary theory, which I think is appropriate, because his friend, who isn't with us tonight, but maybe we'll do another live stream on that. We've certainly done some podcasts, is a big fan of modern monetary theory, and I think it's a fantasy, MMT. But
of course.
Yeah.
He actually started a podcast last month called the Modern Monetary Theory Podcast. It's the only MMT podcast on the iTunes.
Well, that's probably a good marketing idea, but that doesn't mean the economic theory works.
Well, you might as well, do a magic podcast, and just wish fulfillment. Think of something, and then it's yours, because that's kind of what modern monetary theory is. So it's founded in 1711, South Sea Company, was a scheme to get the public to finance the war debts, because war used to be a hobby of the nobility, particularly the king and the queen and all that. But they'd be left broke from the war, because even then, wars were extremely expensive to fight, even though it was a gentleman's pursuit. And so they're thinking up basically a scheme to get the public to actually pay the war debt. And we didn't have central banks back then to just print up money in unlimited quantities and all of that. So they came up with the idea these Spanish colonies were extremely wealthy, and they would offer the South Sea Company exclusive rights to trade with the Spanish colonies. And in 1717, they started assuming the war debts. By 1719, the South Sea Company owned half of the British national debt. That sound familiar?
Yeah, it does sound familiar. Yeah.
Yeah. So we go on to the next.
Definitely. So it's odd that you said war was a hobby of the nobility. Do you want to elaborate on that one?
Well, we didn't have massive armies.
Right.
The armies were composed, just like the chessboard. You had knights, right? You had basically squires, and you had the aides, and the knights went and basically, jousted and banged each other's brains out. And then you started later on with mass armies, but that was more in the time of Napoleon, where you had these massive armies killing each other. Back then, it was like a few thousand guys going up against a few thousand guys, so they kill each other off. Nobody was overly concerned about it, but it was a brain drain, because these were probably some of the few people who actually were able to read and write during that era. So it was a rich man's pursuit. We didn't have mass casualties much later. Maybe in Rome they did before, but we're talking Middle Ages here and Dark Ages. And like I said, you had warlords, right? Feudal kingdoms.
Mm-hmm.
A few hundred people would fight it out, and that's how it worked. So what was really cool about the South Sea bubble is when people saw like how the stock went up, massive increases, everybody started their own bubble company, and people would be selling worthless shares on the street corner, making fortunes in a day, and then disappearing. And that they were called bubble companies. This is where the term bubble came from. And fraud was rampant. Parliament was forced to pass the Bubble Act of 1720 to try to put a lid on it. It did no good. And like I say, rags to riches and back again in a matter of a week. South Sea Company was never profitable. And the people who bought shares of these bubble companies, because you could use them for collateral, just like you can today. And there weren't any, there was no limitations, no regulations. So people would be financing all their stock purchases with borrowed money. And then when the bubble popped, that was the end of it. And of course, it ends again with a government bailout, because the kingdom is in a total depression, and there has to be a restructuring. But it evolves from this point. This was kind of the first time. If these guys were alive in the early 2000s, they would have been selling collateralized debt obligations. They'd be securitizing mortgages, and they probably would have come up with the liar loan, because that's how devious all this was.
But Kerry, that's just all, and I'm using the quote sign here, that's all financial innovation.
Yeah, exactly. Fraud.
Yeah. AKA fraud. Yeah.
I mean, some innovation is good, like ATM cards and credit cards to some extent, and the ability like to Venmo money. But a lot of it is just there for Wall Street to basically shear the sheep.
Yeah, right. So just remember, if you learn only one thing tonight, but you're going to learn a lot more, when you hear a Wall Street crook, which, Wall Street is the modern version of organized crime, as I always say, when you hear them use the words financial innovation, be careful. Hold on to your wallet.
Yeah.
Right?
Yeah. But there are a lot of great innovations that came along over the years, but they've all been abused and turned into something else. So we go on to our next slide.
Good old John Law.
Yeah,
one of my favorite characters throughout history.
He is one of my favorite rogues because I don't think he started out being a scammer.
Yeah.
But I think he just, once you start printing the money and dopamine's flowing, there's kind of no way to stop.
I mean, was this the biggest bubble scam of all, John Law?
For its day, I don't know that it was any bigger than the South Sea bubble, but it was much more profound.
Yeah.
It led to all sorts of bad things happening in France, and they were still paying off that debt. They just finished paying off some of that debt from the early 1700s. I think about 20 or 30 years ago, I read. And that surprised me because most countries just out and out default on their debt. It never gets paid. But France actually paid off debt from around this time, and which was a milestone. I was shocked to read it. I should have researched it more, but in any event, we go on to the next thing, and the Mississippi bubble, it's the same kind of deal. If the federal government in France, French federal.
So we're talking about, just to get a period, 1715.
Yeah. Okay. So basically, government's broke. King Louis XV is a toddler. It's being run by a committee of like the regents taking care of this kid. And, they needed a way out of this, and entered John Law of Scotland, who was a banker. And, creative finance, we're looking at the origins of creative finance here. And on the next slide, you'll see more. So when in doubt, start a central bank. And it really was the predecessor of modern monetary theory. And paper bank notes, mind you, a note was issued. And what is a note? Well, when I borrow money from you, I give you a note. It is in legal terms, evidence of an indebtedness. Okay, it's not a bill, which a treasury bill was actually money issued by the treasury. This is a note, which is the obligation of this central bank. And it wasn't legal tender, but sometimes convenience wins out, and they're so easy, they just passed them around. They became legal tender.
Yeah.
And then he came up with the brilliant idea he'd create reserves by selling stock in this central bank. And they might not have called it a central bank. We kind of, in history, looking back, will refer to it as a central bank. But really, it's more than that. But it's different. And as the stock price went up, so did the number of banknotes, because we're backed up by all these shares, and people would buy the shares, they'd get reserves, and then they'd issue more banknotes. So
it was like a double fiat then, right? Now fiat, the word fiat means by authority or by decree. In other words, something has value because I said so, or the government said so, the central bankers said so. So that's why they call it fiat money, because it has no intrinsic value. It's just valued by decree. But John Law basically had a double fiat, right? Or was there even a triple fiat in there?
Well, it's kind of like what the Federal Reserve does now. When the federal government needs money, the Federal Reserve basically, they issue a bond to the Federal Reserve, the federal government, the Treasury, saying, here's our IOU for $10 billion. And then the Federal Reserve prints up $10 billion out of thin air and gives it to them. And then the federal government has to pay interest on that money that they just borrowed that was dreamed up out of thin air. And you can see how over time your interest costs become enormous. Supposedly 70% of the federal debt, this was several years ago, was interest alone. Which is a great argument for abolishing the Federal Reserve and letting Treasury just issue money. But there's issues with that as well. So effectively, this is the forerunner, the precursor towards using bonds. So it's a double entry kind of thing. For every dollar that gets created and given to the federal government, there's a dollar of debt on the books that the federal government will pay interest on. And that's kind of what they did here.
Yeah, amazing. There's an old saying, if you have a gun, you can rob a bank. But if you have a bank, you can rob the entire world.
And if you have a central bank, you can rob all the banks in the world and nobody can say anything about it.
Yeah, it's unbelievable. These bigwigs have really set themselves up nicely, haven't they?
Yeah. Hey, well, somebody's got to do it. It's a dirty job, and somebody's got to do it, and they got to get paid for it. But what we're seeing now is nice and clean, makes a lot of sense, and well,
you're talking about the property on the screen,
yes.
Right? Okay.
Yeah.
Thank you for that segue. So we just thought we'd take a little intermission for a moment, and we'll get back to the bubble talk. Because, by the way, you're going to get to the question: is real estate in a bubble, right, Kerry? So that'll be a topic of one of your slides. But you may not be able to see this on the screen, folks, very well. I'll try to point my mouse to the spot we're talking about, and we'll just read it to you. But this is one of many property pro formas that you can see at jasonhartman.com in the properties section. And we standardize our data. As you probably know, we help investors buy properties nationwide. And I've been doing that for 16 years, or really almost 17 years now. And it's been a great business, been a lot of fun. And I've been investing nationwide, and that's been very rewarding. We like these prudent, linear, kind of boring markets. What I mean by linear is markets that just sort of chug along and do their thing. They're not too exciting, but they produce great yield or great cash flow. And that's what we really like about these properties. So Naresh, tell us a little bit about this one.
Yeah,
by the way, Naresh is one of our investment counselors. Go ahead.
Yeah, thanks for that. So this is a new property that just came to market last week. And it's a new construction, meaning it's not done being built yet. I talked to the seller or the builder, and it's going to be ready within the next 2 weeks. So in early to mid-August, it's going to be fully done, and they're already looking for a tenant to move into this property. But the reason why I picked this is because the numbers just look very, very strong. And I think, Jason, you'll probably agree with a lot of what you see here. So if we take a rent to value ratio, so right now the estimated rent, so again, this is estimated, they don't have a tenant in there already, but they're estimating it at, I believe that's $16.85.
1685. Oh, you can't read it either, huh?
I do have it on full
screen. You're reading it off of where everybody's. I'm looking at it on the big screen.
Oh,
so
okay, yeah.
It is. This property is brand new construction. It'll take about $61,000 with closing costs to acquire it, subject to qualifying at 25% down. And these are investor loans, so they're not quite as desirable as owner-occupied loans. And the projected rent is $16.85 per month. Now, what that means, and I've got to look around my screen that's in the way because I prop it up for the live stream. So that means the projected cash flow is $400 per month, $400 per month on this property, single family home. But that puts a cash on cash return at 8% annually. Now, you may be thinking, well, 8%, that's good. If I could do that consistently, that's actually quite great. But wait, there's more, as they always say in the infomercials at 2 o'clock in the morning on TV, right? And, income property, the thing that makes it the most historically proven asset class in the entire world is that it's a multi-dimensional asset class. meaning you earn your return on investment in many, many ways. Most assets are one-dimensional. It's buy low and sell high, okay? Some assets are two-dimensional. Buy low, sell high, get dividends or cash flow or income in between. But income property is multi-dimensional. Yes, buy low, sell high, sure. Get cash flow. Also get tax benefits, get leverage, get what I call inflation-induced debt destruction, my trademark phrase that's kind of a mouthful. And, if you want to know more about this stuff, check out the YouTube channel or my podcast and, or our event this weekend, our Meet the Masters conference, which is virtual, by the way, so you can attend from anywhere. And there's a lot more to this that we don't have time to explain tonight. But that said, with all of those things and very conservative assumptions with appreciation and vacancy rate included, because your property is not going to be occupied every single month. We estimate it'll be vacant 1 month per year or 8% of the time. It might be filled for 2 years, but then you have a vacancy for 2 months. So we just average that at 1 month per year vacancy. And the overall projected return on investment on this performer right here is 33% annually, 33%, okay? And this is why people become so wealthy with income property, because like an iceberg, okay, most of it is below the surface of the water. And people with income property, a lot of times they hurt themselves because they just don't know how to do the math. They might think they're losing when they're actually winning because they don't know how to calculate the return on investment. And it's a very simple asset class. It's a very straightforward asset class. You're in control of it. You're not, giving your money to somebody else or letting some fund manager control your money or some Wall Street crook steal your money or anything like that. It's your property. You control it. It's yours. And once you just learn how to read these pro formas, and by the way, we have a fantastic 27-minute video on that on the front page of my website at jasonhartman.com. And that's just free. That'll teach you how to analyze a real estate deal and basically how to be a great investor. That 27-minute video is the core content. And it'll go through every single number on this pro forma in detail. And in 27 minutes, you'll really get a great education on that. So after this live stream, do not pass go. Do not collect $200, but do get $100 off for our upcoming event when I give you the promo code. And go and watch that video. Okay, so that'll be great. And Naresh, anything else about this one you want to share?
Yeah, just a couple of things. So you talked about the cash on cash at 8%. I'll tell you, compared to what, relatively speaking, that's extremely high for new construction that we've been seeing this year in 2020 and last year, 2019. That's really just a coup. And the other thing is, this is the pro forma is making the assumption that you're putting 25% down. So we, I tell our clients, see if you can put 20% down instead of 25, and that shouldn't really change the interest rate much. You should be getting something similar. So the numbers would be even better. So this
and by the way, just to expand on what Naresh is saying, the reason the numbers are better when you put less down is you have more leverage. So your cash flow actually declines a little bit. Maybe, and I don't have the numbers in front of me, but maybe it goes from $400 a month down to $350 per month, just for example. But your return on investment goes up substantially because you have less money in the deal. And the great thing about income property is it allows you to be bigger than you really are, in essence. That leverage, Archimedes, who had the famous quote about leverage, the ancient philosopher, he said, "Give me a lever long enough and I will move the entire world." And that's basically the point of leverage, and why using good quality, long-term, incredibly cheap fixed rate debt, you can basically multiply whatever you could normally do with another asset by 4 or 5 times with that leverage. So that's why the return increases. Go ahead, Naresh.
Yeah, and the last thing I'll say is this is in Cincinnati proper. It's not some city 30 miles away from Cincinnati. We've had clients tell us, the pro forma looks good, but I've never heard of this city that's 30 miles away from Memphis or 30 miles away from Little Rock, Arkansas. Yeah. So if you do your research on Cincinnati, it's still a very industrial city, lots of jobs available. Population growth has been growing in a linear manner, like we talk about all the time. So it's a very, very kind of nice, I wouldn't even say up and coming. It's kind of already come.
Well, we did a property tour in Cincinnati a couple of years ago. It was great. We were very impressed, and a lot of our clients purchased properties at that time. And, we have many markets: Atlanta, Memphis, Indianapolis, a lot of stuff in Florida right now. I mean, Florida is just booming. Mm-hmm. And by the way, all three of us live in Florida. Isn't that funny?
All three of us moved here too.
We're all immigrants, of course. Yeah. Kerry's from New York. Naresh, you're from Houston, but then you went to Duke University. And did you get your MBA at Duke or just your undergrad?
Yeah. I was an accelerated MBA, but I moved from Maryland. I was working in Baltimore, Maryland.
At Agora Financial, right?
Yeah, Stansberry, Agora Publishing.
Stansberry, yeah, good stuff.
And so migrated here after Maryland, and I don't regret it at all. Florida.
And that was a great decision. Yeah, much better than living in Baltimore. That's good. Okay, good. Well, hey, we've got another property we thought we'd show you. This one is in Mississippi, but in the interest of time, maybe we'll come back to this. Let's get back to our presentation. Oh, actually, Kerry, you know what? Can we take a couple of questions? Because we got quite a few.
Sure.
Okay, so a couple of questions. So Charles Sipe says, hello from sunny Tacoma, Washington. I think you're probably being sarcastic, Charles, but maybe it's one of the rare sunny days, right? Yeah. So
summer might be.
Yeah. Oh, and here I can actually put these on the screen. So Thomas L., what do you think of buying larger lots with mobile homes on them? The rent-to-value ratio can be decent. Well, I own a mobile home park with a client. We bought it together, a client of mine, and that's been a really good investment. We like mobile home parks. It's a specialty. And by the way, one person watching, a friend of mine, is a mobile home park investor. I think he's still watching. Yep, there you are, Kevin. Hey. And so those can be good, but that's a specialty. That really is a specialty. You got to know what you're doing. And that's a much more active style of investment than most of our clients like. Our clients are usually investing in something to invest in, not to run a business. And having I've had large apartment complexes that I've owned, and that's a business. Okay, it's different than an investment. So much more active thing. Okay, so Britt says, hi, Naresh.
Hey, Britt. Good to see that you're here.
Yeah. Okay, Coleman, I live in rural Maine. I just signed paperwork with a realtor to sell my house. She said to list it for, I think you meant $259,000. I owe $75,000 on it. Two-family, I guess it's a duplex. That's what you mean. It's a two-family home. I can rent each unit for $1,300 with, I guess you're supplying the heat. Okay, that's in Maine. That's the thing you think of. That's actually costs a lot of money, right? Good idea. So, what is there a question there? Can anybody make that out, or just a comment? That's just a comment. Okay,
yeah, it looks like
good stuff. Okay, so what's this one? If I can purchase a single-family investment rental with RV, and by the way, RV ratio means rent-to-value ratio of 1% is what they mean. Would you go for it or wait for prices to go down next year?
I have an answer to this.
Yeah, go ahead.
Yeah, so this is a very, very common question that we're getting from clients. It's, should I wait for the depression to happen and prices are going to crash and I'm going to get a better deal? Yeah. And my answer is, number one, we don't have a crystal ball, so we don't know if that's going to happen. But what I'm seeing right now in the market, if you go to our website, jasonhartman.com, and check out our inventory, and the reason why there's not a lot of inventory is because people are buying. The idea that there are no buyers and the property values are going to crash. We have not seen it this year. And until people stop buying, and maybe if interest rates are not going up, the Fed said at least through the end of 2021, they're not raising them. But until people stop buying, I don't see the prices going down. Now, could they go down? They could. I could be wrong.
It could happen. But look, folks, we still have a massive housing shortage. Before COVID 1984, which, by the way, I love that, Kerry Lutz. You told me about the other night. We're going to call it COVID 1984 because that's what it is. It's becoming an Orwellian mess. But the market is absolutely booming in the type of properties that we sell. It is insane how fast people are buying them. But remember, there's no such thing as the market. In a country as large and diverse as the United States, you have about 400 real estate markets. 400 real estate markets, okay? And they can all be divided into one of three categories: linear, cyclical, and hybrid. Now, on top of that I've been teaching for the last 17 years, you want to divide them another way, but they usually coincide fairly well. You want to divide them between urban, suburban, and rural, okay? And right now, as you see at the bottom of the screen, I was the first person that I know of to predict this in early February. Now, in COVID 1984 years, that's like dog years. That was a long time ago, okay? Although it's not that long ago in real life. And people are fleeing out of densely populated areas to suburban markets. And guess what? All of our properties are in suburban markets, all of the properties we've been recommending for many years. So this is what people want. They want a place where they can socially distance, where their cost of living is lower, and where they can have multiple home offices, where they can have a gym in their house, and where they can be comfortable. We all probably know people who live in places like New York City or downtown LA or downtown Seattle, or even downtown San Diego, Boston, whatever, Miami, places where you've got civil unrest, you've got riots, you've got places where you can't socially distance, where you've got to take mass transit, another danger zone, that and an elevator. Those are places that people are worried about getting sick. And, regardless of how bad the economy is or gets, which I don't deny that the economy has serious problems right now. Number one is, will they create inflation with all the money printing? And I think Kerry, our guest, will probably address that here in this presentation a little bit. And number two, what trend will be more powerful? Will the trend of, the economy's on the rocks and there's too many people unemployed be the most powerful trend? Or, do you even need to worry about that? Or do you just need to worry about your little segment of the economy? And will the trend of this mass migration to suburban markets be the more powerful trend? I mean, look, it's uneven. It's an uneven thing. But the point is, as Wayne Gretzky said, he was a successful hockey player because he would skate to where the puck is going. And the puck is going to suburban markets. And 84% of the country lives in what the census considers an urban market. So think about that. Think about how many people could flood these markets that already, they are flooding them now, but there's more to come, that already had a housing shortage for the last several years. Okay, there's been a housing shortage for years. And now you see this mass migration trend increasing. Okay.
Yeah, and the other thing which you didn't touch on is interest rates. So you talk about this on your podcast all the time, where interest rates are their lowest ever in human history. And you're essentially getting a free mortgage. I looked at the May inflation number that was published, and the inflation rate is at about 3%. It's probably more than that, but the published rate is 3%. Right. So right now you can lock a 30-year fixed rate, 20% down mortgage at about 3.5%. So that's just such a good deal to be able to lock something like that in. And look, if you want to wait until next year, That's your choice. But this is a great deal today.
Yeah. What Naresh is really saying is essentially you borrow money for free. You're getting paid to borrow the money. By the time you take inflation and tax deduction, you're getting paid to borrow. It's truly incredible. Okay, this will be the last one for a few minutes here, and we'll get to some more questions at the end. So Coleman says, I wanted to refinance and pull all my equity out, but I can't because I'm out of work and probably until at least March because of COVID-19. Folks, this is another reason right here. Thank you for raising that question, Coleman. That's a really good point, or not question, but just a comment, is that, look, if you have equity in a property, you are in the highest risk position, okay? I did a video last year when we were on a Scandinavian cruise out on the deck of the ship, and it was super windy, but it was good video nonetheless, okay? About the rare time when you want to pay cash for a property or have a lot of equity in a property. If we get on bad economic times, which, you know, some would certainly say we're already in, okay, you want to have control of that equity. You want to have it out of the property. You don't want to have it stuck in the property, because if you lose your job, you're never going to be able to refinance it, okay? Yeah. But you pull that equity out first when you've got a job, okay? And then you have control. You can pay for your living expenses with that equity, okay? So you want to get control of the equity. Equity in a property, you know, I always say real estate is a fantastic investment, but it's a lousy bank. It's not a good bank, okay? It's not the worst bank ever. It's just not the best one either, okay? But you want to get control of the money and get it out of the property, okay? Separate the equity from the property. The property will go up in value, down in value. It'll produce the same income regardless of how much equity you have in the property, okay? All right, so thank you for the comments and questions. Keep them coming. I know we've got some more, so we will get going. And David Nelson is asking a question, and that's Sarah's client. So Sarah, you got to get a hold of David and help him with the Cincinnati property. I think he's interested, David and Gina, and they were on our last live stream. Kerry, it's all yours.
All right. So, of course, we had a crash. And understand this crash was connected to the South Sea bubble crash, but we don't really need to get into that. Just the aftermath. The government limited the payment of gold and silver, which was real money, in an effort to stop the crash. Devalued the notes issued by the bank by 50%. And you can imagine what that did to the stock price. Many people went broke. And of course, John Law was viewed as a bit of a fraudster. Now, one interesting thing that I found interesting is the French word millionaire originated as a result of the many people that were made wealthy as this company, they call it, shares soared. And so that's where we get that term millionaire from. And interesting that it's just part of the regular vernacular now.
Yeah.
It came from a bubble. So
I did not know that. That's fascinating. Yeah.
Yeah. And at this point, they were printing up unlimited amounts of money. Anybody who wanted banknotes could get them. And of course, this led to hyperinflation, and really John Law has kind of got his place in history as having masterminded all of this. He thought he was a banker, an economist, but he really didn't quite get it.
Yeah, absolutely. And you know, Kerry, the point you just made about the word millionaire is interesting because I don't know if anybody remembers this old show on TV, but it's called Heart to Heart. And I remember that show, and the intro of the show had Max, the chauffeur. Kerry Lutz, you remember this show? Okay?
Yeah, vaguely, yeah.
Yeah. And
Robert Wagner was in it.
Yeah, Robert Wagner and Stephanie Powers. Okay. Yes. And so I looked that up on YouTube because I wanted to rewatch the intro to that show. And, you know, it's got Max, this is my boss, Jonathan Hart, and he's a millionaire. And it showed, you know, the yacht and the mansion and the Rolls Royce and the, you know, big enterprise that he owned. Like, A millionaire is nothing anymore. Inflation.
Middle
Okay?
class.
Yeah.
So, well, when I think of millionaire, I think of the Beverly Hillbillies.
Yeah. Nowadays, it's probably
Next
lower
thing-
than the Beverly Hillbillies.
Right. The next thing you know, old Jeb's a millionaire.
Yeah.
And they moved to Beverly Hills, right?
And that's because of inflation. It's not how much money you have, it's how much is the money worth, right?
Yeah. Converse, which happened here, is the purchasing value of the currency diminishes. That's kind of the definition of inflation.
Yeah, yeah, absolutely. And by the way, do you see the ticker at the bottom of the screen? Thought you'd like that one.
Yes, and you just have to go to the supermarket, and you can see. My feeling is now what's happening with gold, commodities, and copper especially.
Dr. Copper, yeah.
We're beginning to see the beginnings of commodity price inflation, which means that within 6 months to a year, we will see consumer price inflation. And to me, the best measure of consumer price inflation is the cost of a Thanksgiving Day meal, because it's constant and it's something that they don't fudge. And we've seen it been stable, gone down a couple cents a few years. Expect this Thanksgiving or the one after 2021 probably go up substantially.
Yeah, yeah. And as real estate investors, we love inflation. Good stuff. Okay, we're ready to go to the next slide?
Yes, please.
Okay. There we go. Oh, good.
This is one of my favorites.
This story is great. Yeah.
Bubbles are entertaining. Aside from everything else, I hope all of you are enjoying this. If you're enjoying it, just send an email, send a message to Jason and let him know, because bubbles are fun. Because people do the dumbest things. They look foolish, and we're all guilty of this kind of behavior at one time or another. But when you got like guys who've never worked a day to make their living, and I'll explain how this bubble unfolded. It's really amusing, and those pictures actually were taken from during the time of this bubble.
Yeah, and it like collapsed in an afternoon, right? I remember that story. Yeah. Yeah,
it was amazing. So let's go to the next.
Okay.
All right. So the casino mentality takes over, and that's like I like to use that Dire Straits song, "Money for Nothing" and "Your Kicks for Free." It's I want my MTV.
Yeah,
it's where it kind of takes over these unrealistic expectations. But it's worse than the casino mentality, because in the casino, most people are losing. In the bubble, while it's going on, most people believe they're winning. And if they get out early, they will win. But very few of them are able to do that. And that reminds me of a saying that Bernard Baruch used to say, "I got rich letting the other guy make the last 10%.
Yeah, right.
So, and you had these outside companies. They weren't Kuwaiti operating companies, but they were able to register on the Kuwaiti Stock Exchange without being subject to any regulation whatsoever. And I really don't think the Kuwaiti stocks were that regulated either, but it was more an honor type thing. And they had this massive run up in shares and share prices on the exchange. And the way they paid for shares wasn't through a wire transfer or a check, it was using a post-dated check. And eventually, under the Kuwaiti culture, default just never happened. You didn't dishonor your check ever. I mean, that was like, I guess they cut off your hand under the law there. And one bounce check started a cascading default where virtually all the checks bounced. So, of course, the government had to step in to minimize the damage. There was $91 billion worth of worthless checks. And that was $90,000 for every man, woman, and child in Kuwait. And so obviously this one didn't work out too well, but it's kind of entertaining to see the way the way it happened. I avoided using the U.S. Crash of 1929 because, everybody knows about it. It's pretty obvious. I think it's more interesting to look at these lesser known bubbles.
Right. So you didn't use the Great Depression because that's, we've all heard of that, right? Yeah.
Exactly. And this was the summer of 1981. It's still pretty recent. The Great Depression is 90 years.
Yeah.
91 years ago. So it's just not as relevant as it once was. And there's bigger bubbles now. And these other bubbles were bigger than that.
Yeah.
But it was definitely a bubble. So I just want to say that. So the question is, are we in a bubble today? And I would say bubbles, because there's so many markets you look around at and they seem very inflated. The stock markets, obviously, real estate markets, you think certainly in different markets, well, they were inflated up until recently. New York's prices are way down. All these big cities, the go-go markets, way down. And they were headed down anyway. The recent pandemic and social unrest, kind of like the pin that popped these bubbles. Let's go to the next. Okay, so here we have government debt. And I'm not going to bother boring you with the numbers, but that kind of looks like a bubble. And the only reason why it can be a bubble is because people think that the government's going to pay it. And yes, they will pay it, but they might have to print up more money and borrow more money to pay the debt. So where does that leave you? Eventually, this bubble is going to pop.
So when we talk about the government debt bubble, what does it mean when it pops? Does it mean it pops with inflation or loss of reserve currency, or what do you mean by that?
Well, it's some kind of loss of faith event. A loss of faith. Go to the next slide and we'll see.
But before we really talk about that, isn't the back on the government debt for a second, isn't the compared to what question the question here? Because Japan, even though it's anemic and it's like a zombie economy for a long time now, almost 3 decades, it's still plodding along, and it's got debt to GDP that's much worse than ours, right?
But they had a high savings rate.
Mm-hmm.
They still do, elderly population. So high savings rate to pay for a lot of this deficit financing. They also have a large balance of payments surplus with the U.S. and the rest of the world, because everybody's buying Lexuses and Japanese. Not as much as it was, but they still are sought after. So they were able to finance this, and but it's been a lost generation and a half.
Yeah,
it's been a zombie economy where they just haven't had really any growth, but they were so wealthy during the 80s that they made enough to finance it. But eventually they're going to have their day of reckoning, like all others.
The thing with Japan too is it's got such a big demographic problem. I mean, Japan, literally, the country probably won't exist in 70 years because they have no children. You got to have, if you don't have people, you can't have a country. That's the basic idea, right? Okay, and they just don't have any kids. So it's it's an
aging economy, aging populace rather, aging demographics. It's demographic. So that money supply, if you look at it, has gone up almost not quite as fast as the debt rate, because it's a little more complicated. We don't need to get into the mechanics of how money is born and destroyed.
That's like at least a 4-hour discussion.
And fractional reserve banking and a bunch of boring stuff. It's more fun to look at bubbles.
Oh, I love that stuff. I think that stuff's super interesting. You do too. You like that stuff.
I do, but I don't think our audience really wants to hear about it. But
that's another time.
The U.S. debt is directly tied to the U.S. monetary system, right? Because all of our money is born into existence through debt.
Yep.
And so therefore, loss of faith of the currency will lead to a popping of the debt bubble. And, it's right now the Federal Reserve is buying most of the debt anyway, and it's being monetized. So the day of reckoning could very well be around the corner. Let's hope it goes for another 100 years. So it isn't our problem. Let it be our great-great-grandchildren's problem. Just kick the can down the road. It's worked for 100 years now. Hopefully it'll work for another 100 years.
Yeah, well, that's what always happens. It's always kick the can down the road. But usually they have some incredible innovation or a debt jubilee. I don't know. Naresh, Stansberry's book, my mom finished it a couple of months ago, and she called me up and said, "Jason, what do you think about a debt jubilee? Is that going to happen?" I don't really think so, because it'd be so uneven. It's so unfair. Like, just for example, right now, what if we had this crazy idea? I mean, listen, I think student loans are a complete ripoff, and the whole college industrial government debt enslavement complex is a scam.
Brainwashing. You forgot brainwashing.
Well, and it's a brainwashing thing too. But regardless of all that, I don't think it's at all fair to have like student loans forgiven. And the reason is, it's like, what if I didn't go to college and I don't have a student loan? What do I get, right? Or what about someone who just paid off their student loan last year or last month? That's not fair.
People spend 20, 25 years paying off their student loans, and
it's a rip.
In fact, some people never pay them off.
Oh, that's true also. And it's the only debt that's
non-dischargeable. There's
in bankruptcy, yeah. But here's the thing. The point is, a debt jubilee only benefits people with debt. Okay? So, if you think that's going to happen, then start taking on a bunch of debt. And the safest, most prudent way to do that is having debt against good quality income properties. Okay? That's why multidimensional asset class, you can do a lot of things with it. Okay. Any more on money supply?
Just that jubilee. Just remember that everybody's debt is somebody else's asset.
Right.
So it's all well and good to get rid of all the debt. And like you said, people who are savers, they get screwed because they own the debt. But also the banking system would have to be completely reconstituted, which the way things stand now, probably not a bad thing. But a jubilee will only happen. It'll be kicking and screaming to that being the only possible way to do this, to manage the debt. There's wars that can happen. There's a lot of things we don't know about that the big guys will utilize to bring on the new system that they are.
I certainly think the new system that's coming is some form of digital dollar. And I think that's the cryptocurrency that's going to win the game. By the way, I think you've got a slide on here on cryptocurrencies, Kerry. So let's
move on.
Yeah. So here's good old real estate that we're talking about. Yeah. What do you think?
I think when you look at that little hump, it looks like a camel's back kind of there.
Right here.
At that point, there was definitely a bubble in real estate. And that was 08, 07 through 09. And then it got liquidated. We see that gray area is the recession there that ensued. And then,
price discovery right here.
Yeah, we have prices recovering.
No, I said price discovery, but it's also recovering, yes.
Yeah. And now it's not parabolic. Yeah, it's a very healthy increase in valuations. But understand, like Jason said, there's hundreds of real estate markets. Cincinnati didn't see the prices go up like that.
Right.
New York City, Miami, LA, and San Francisco, Boston, other go-go markets, they saw it.
And the other thing you've got to remember is that very few people buy a house based on a price. They buy it based on a payment. And because the interest rates are so much lower now, What really we should be looking at is this chart of prices, but then the next chart should be prices compared to mortgage payments.
Yeah, affordability index.
Right? Yeah, because if you overlaid the interest rates on this chart, and then you overlaid the mortgage payments on top of that, and then to have the affordability index, you'd need to overlay the income on top of that to see what incomes people are making compared to those mortgage payments. And that's the housing affordability index right there, which is a good index. I like that index.
Yeah,
so, good stuff.
All right, so S&P 500, that's looking a little bubblicious there from 2012 on. I mean, it just took off. And so you could make the argument it's almost an exponential move. It doesn't show the collapse. It only goes to 2016. We went higher and higher, but then we've come down. So definitely in bubble territory there.
Yeah. And what do you think about these price to earning ratios and the stock buybacks and, just the financial fraud that's occurring legally?
Oh, yeah.
It's like legal financial fraud everywhere you look on Wall Street.
Yeah. It's all Chinese stock market now. So what's interesting about it, though, Jason, is the increase in stock market prices. A lot of it has come from foreign companies, foreign, wealthy people, funds, dumping their money into the stock market because they feel that it's the last secure place to put their money, which obviously we know there's flaws with that theory, but it's flow of funds, demand, and it's also a function of unbridled money printing because you've got all this liquidity, it gets dumped into the market. So it's, the last bull market we had, which ended just in March, arguably of this year, was the most hated bull market in history. Nobody believed it was a bull market. Very few people predicted the extent. And my feeling is it's going to rise higher because liquidity, there's so many trillions of dollars of federal stimulus money floating around that it's going to get sucked into the market. And then you had also the perversity of share buybacks, borrowing money to buy back your shares to inflate your per share earnings, which then gets you a higher bonus, and because your bonus is tied to the performance of the stock price or the earnings per share.
It's like a double cycle. Yeah.
And like the airlines, Boeing, from 2012 to 2020 bought back $45 billion of their stock.
Yeah, so you mean airline manufacturer, but I was going to talk about American Airlines. I so hate that company. I can't even tell you. But they're all rushing to get a bailout. They lined their pockets for all these years. You'd think they would, like, Kerry, I can't believe it. They can't last a month without a bailout. These are giant companies.
No, because they took all their cash. The airlines, the major airlines from 2012 to 2020 bought $45 billion worth of their stock. How much is the bailout for? About $45-50 billion. Same with Boeing. They got $60 billion. And these were companies, the management should have been fired, and at the very least. And I created something called Lutz's taxpayer bailout Bill of Rights. And they actually, some of it wound up in the bill. We shouldn't be allowing these companies to lobby the federal government when the federal government just bailed them out. But, that's the world we live in, and we're not going to change it. But we can profit from it. So let's go to the next.
Yeah. Well, I got a question for you, Kerry, regarding this chart. I know it gets cut off at 2016, but do you think that bubble burst earlier this year? We know that the S&P went down.
No.
So that decline that we had in late March, that was not the burst.
I think this bubble goes for quite a while longer. contrarian in that belief. Everybody thinks it's going to retest its lows of March, but it hasn't happened yet. And here we are. We're in July, and we've got 27,000 Dow. We've got the NASDAQ at all-time highs. The NASDAQ is in the black for 2020.
Yeah.
So does that sound like a bubble pop to you? I mean, I didn't even do the NASDAQ's chart.
Yeah.
It's actually a better bubble, but I did the components here. Apple, look at that. All right. So it doesn't really go parabolic. 2016 is a really critical year for the NASDAQ and a lot of the other stocks you're going to see here. It really goes parabolic here, but it's not as, it's got a ways to go, in my opinion, to hit the exponential level and then crash. Maybe it's $500 a share. I don't know the answer. It just looks to me like it's incomplete. But if you could, a lot of times you can scrunch the charts up by putting more years in the same space, and it'll make it look even more parabolic. But we got some great examples here. So let's go to the next.
Wait, well, but I can't wait till you get to the one that starts with T. But go ahead.
Well, of course, we're going to get to that one.
Yeah.
Of course. Look at this. So it went up a lot, but then it kind of zigzagged there.
Spoiled it. Okay.
2018, it kind of zigzags, sawtooths, but then it goes up. So if we kind of just cut out that little time period where it's sawtoothed, and that wasn't really that long a period of time, it looks like it's going exponential too. So it's just something to consider, because it's $3,000 a share. That's why the NASDAQ is at its all-time high. Amazon's the most valuable company, I guess, in the world. So $1 trillion company. All right, let's go to the next.
There you go.
There we go.
This is the one that is insane. I mean,
yeah, I'm sorry that it came down, because it was at 1800. Look at that chart.
This if there ever was a tulip bubble, it has to be this one.
Yeah. Hey, well, maybe they'll be giving free Teslas instead of paying their employees. I don't know what's going to happen there, but by any stretch of the imagination, the bubble is going to pop. But it could go, the old saying, Jason, is the market can remain irrational longer than you can remain solvent.
Yes, tell that to the short sellers, right?
Yeah. Like these short sellers have lost billions of dollars.
And the funny thing is, well, not the funny thing, but the sad thing is they're right. I mean, that's what I say.
Another thing, there's another old saw on Wall Street. There's nothing worse than being right at the wrong time.
Yeah.
And that had been at the wrong time. That's the danger of short selling. And we've seen people go bankrupt, funds go bankrupt, shorting Tesla. Not well advertised, but they have. Yeah. All right. So let's look at our next.
Absolutely.
And this is my favorite one, contemporary bubble. It's Bitcoin. And if we look at that run up in 2017, it is nothing short of stupendous, going from $100 to 19,000 and change is just, like I said, I knew it was a bubble.
Yeah.
I told everyone it's a bubble. I mean, I wish I had bought it at the low and kept it, because I had the sense to sell it when it was at 19,000, at least half of it. I mean, that's the thing. When you're holding something that's really profited from a bubble, at the very least, when it gets to that thing where it's 100 some odd times your cost, you should sell half of it.
Do you know what I think one of the characteristics of a bubble asset is that it doesn't pay cash flow or dividends. And, Apple pays a little bit.
Apple pays quite a bit. Apple.
Well, I know, but proportionately, proportionate to the cost of it. And so, assets that pay income, I don't think they tend to be as bubblicious. Tulip bulbs wouldn't pay income. Precious metals don't pay income. I mean, the most ridiculous thing though, and I'm not downplaying gold, because I think it is the counter asset to what's going on in the world right now. But I'm not a gold bug either. Okay. And, I'm listening to Peter Schiff talking about how gold's going up, and the anchor person says, oh, he's right. Well, let me remind you that Peter Schiff in 2008 on CNBC said gold would be $5,000 an ounce by the end of Obama's first term. Okay. And that didn't even come close to happening. So yeah, everybody will eventually be right. Okay.
Yeah, that's the case of being right at the wrong time. But, it's kind of the stopped clock. And, the stopped clock is right twice a day.
Today, yeah.
And, Peter is getting to have the last laugh.
Yeah.
Unlike in 07 when he basically, or 06, called out the real estate bust that was impending. This time he has not been anywhere near as accurate. So
I think Peter is super interesting to listen to, but he's just wrong way too often. I mean, he's so intelligent. He's just really interesting. He's so good at sound bites. He just zings these things out. He's
great. Yeah, I've had him on many a time on the podcast.
I've had him on once, and I made the mistake of investing with him and lost a bunch of money. So I'm not.
I also made the mistake of listening to his advice and lost a lot of money when I got started.
Yeah.
Sorry about that. Yeah.
Well, we will.
That doesn't mean you can't learn something from him.
It was good.
He is smart. Yeah.
Yeah. Well, no asset class always goes up.
Yeah.
Right? Every asset class will have a period of decline. And that's just the way it is. Now, some will be less than others. Some are less risky than others. But what was right for your grandparents to invest in probably wouldn't work for you now.
No, because your grandparents were playing the game when we had a gold standard, and we have a different game now. So it's a different environment. Yeah.
What was right for your parents, probably not so much for you now.
Yeah.
But all these things change, and that's one thing that doesn't, though, is that bubbles are blown. One thing I should have mentioned is used to be you'd have one bubble at a time, because there was no Federal Reserve, no central banks to print up money to feed multiple bubbles.
Right.
Now we've gone through what we have called the everything bubble, government debt, student loans, subprime auto, subprime mortgages, real estate, everything.
They can just pump up everything. Yeah.
Right. It didn't used to be that way, because you had to compete for capital, for resources, and capital was risk priced. There's no longer a risk premium for capital. If you're buying a junk bond or you're buying a AAA bond, they're both pretty close to one another in price, because the Federal Reserve is buying them all up. Yeah. So maybe that's part of the jubilee that we expect. So,
okay, so before you get to your conclusions, I want to put the promo code up that I promised. We've got quite a few more questions, so we'll stay on here, folks. But let me just put this on the screen. This is $100 off for our Meet the Masters of Income Property Conference. This is an annual conference, and it's virtual. It starts on Friday evening. Sharon Lechter, Harry Dent, go to the page. You can see all the speakers. Ken McElroy, George Gammon. It's going to be a great weekend, and that's this weekend, and it's a virtual conference. So jasonhartman.com/masters, and $100 off with the promo code JHLive. I'm told that is not case sensitive, so you can do it either way. And just go and register, and that'll last for 1 hour after we end the broadcast. Okay, so you got to register within an hour after the broadcast before the promo code goes away. Okay, so I'll leave that up for a moment and let you talk about your conclusions, and I'll take this down after in a second. Okay, go ahead, Kerry.
So if you got to ask if we're in a bubble, the answer is pretty obvious. It's kind of like when you sit down at a poker table, the casino. If you can't tell within a couple of seconds who the sucker is, you're the sucker. They happen throughout history, but like I said, central banking is pouring gasoline on the fire.
Yeah.
But look, there's a lot of money to be made investing if you can crack the code. And that chart is the code. You know, look, if you bought Tesla at $100 and sold half of it at 600 and you held on to the rest, you know, it probably could work out for you. And you're so far ahead anyway. You know, it's the house's money. And that's the way you have to treat the bubbles, is play on the house's money. Don't play on your money. That's my advice there. And more importantly, though, is if you recognize bubbles when they're happening, and it is very difficult because it's just human nature to be drawn into the euphoria of the moment. But if you can recognize it, you can avoid a lot of painful losses. And sometimes avoiding losses makes you a winner. You know,
it's like the Buffett idea. The first rule is don't lose money. You know, right?
Yeah, and when times are tough, people are more concerned about return of investment than return on investment.
Right.
And that's why you need to do this. And following the trend, investing, it's fun, but it really can be deadly. And just watch what's going to happen to the Robinhood investors.
Yeah. What a joke.
Yeah, they bid up the price of a bankrupt car rental company, arguably the best car rental company, Hertz. They bid it up from 50 cents to $6.50 a share, to the point where Hertz wanted to do a public offering of worthless shares.
Can you? This is like, only in today's world we live in could anybody even say that.
Yeah,
like,
with a straight face. And they just disclosed, you're going to lose money. These securities are worthless the day you buy them. And for once, the SEC stepped in and stopped it. That was the shocker, because all they exist for is just to put a stamp on your filing to say that you've done everything necessary. You followed all the requirements for your documents. We have no idea what's in it, and we don't.
The SEC. If you think the SEC is going to protect you as an investor, you're out of your mind. I mean, the SEC, the acronym, it stands for the Scoundrels Encouragement Commission. Okay.
I thought it was something a little more vulgar than that, but
I don't know. What is the vulgar? No, don't say it. But
I'm not going to say it. This is a family show.
This is a family-friendly show.
Anyone.
Yeah, good stuff. Okay, so hey, go ahead, Kerry, and let's get to some questions.
Yeah, just two more points. And like I said, markets can remain irrational far longer than you can remain solvent. So never think that the market's wrong and you're right, because sometimes, it might be the case, but sometimes, So anyways, I can't read the last point.
Oh, sorry. Go ahead.
Yeah, and finally, pity the poor Tesla shareholders.
Short sellers, you mean?
Short sellers, rather.
Yeah, I feel sorry for them. Yeah. They should have won. Kerry, thank you. That's great. I really appreciate it. That was fascinating and updated. When you gave that presentation in Hawaii, I really enjoyed it. And I told you so at the time. That was great at our Meet the Master, or our Prophets in Paradise conference there. And now you've updated it. So that's great. Good stuff. Well, hey, Kerry, feel free to stay on with us if you want, or jump off, whatever, and we'll just take a few questions here. Okay, so JC, hi, Jason and team. Love your content. I live in Oakland, California. I own outright. In the process of getting a loan on my equity and looking to purchase an investment property in Nevada or Arizona. Thoughts? Well, since I have lived in all three of those states, California, Nevada, and Arizona, I think that number one, definitely either sell or refi the property in Oakland. Okay. And by the way, I'll change this screen so you can all be seen here. Sorry, I'm covering you, Naresh. I can't fix that. Okay.
That's okay.
So yeah, I don't know how to fix it. There's no setting for that on here. Anyway, so you definitely, I think you should either sell or at least refinance that California property. And then, Nevada and Arizona, just most of the good cities and areas in those markets are just too expensive for us. We can't make them work anymore. We have definitely helped people buy many properties in Las Vegas area and also in Phoenix and a little bit in Tucson, but they're just too expensive, those markets. The rent to value ratios just aren't good enough for us. Now, our clients that purchased in there in the past, they did great. But again, we think a lot of the benefit has already occurred. So I wouldn't recommend those markets today as much. They're more hybridish markets. Las Vegas is a little bit of its own beast, though. If you're talking about Las Vegas, you say Nevada, I kind of have to make the assumption you're talking about Las Vegas, and in Arizona, you're probably talking about Phoenix. Okay, I just think you could do better in places like Indianapolis, Atlanta, Memphis, many of the markets we're in now. And you can find those all at jasonhartman.com/properties. Okay. And you can look at the detailed performance like we showed you earlier on those, and they're all there for you. Okay. Okay. So, Jared, I'm used to hearing your podcast at double speed, so please speak quicker.
Oh, we found out the secret, Jason.
Yeah.
That's my secret. But double speed is really hard to listen to.
Yeah, I know.
We're going to go 50% to 3/4
Yeah.
faster, but double then, like Alvin and the Chipmunks.
Yeah, I agree with you. Jared, you may be listening to me at double speed, listening to my podcast, but are you retaining enough information? That's my.
There will be a test.
I don't know how you can listen to it at double speed. I do speed things up, audiobooks and podcasts when I listen to them, but 1.5 is about all I can get now. Maybe if you're younger than I am, you can get it better, but it's just too fast.
Red Bull. You have to speed your body up.
Yeah.
You got to take some kind of stimulant, heavy stimulant, to listen to it at twice.
I'm a coffee drinker.
I'm too old for that. Coffee's not enough.
Yeah, coffee's not enough. Okay, and Sarah saying. Okay,
fun.
so Eric says university equals liberal indoctrination camps. I agree. Yes, you're absolutely right about that. It's ridiculous.
Or like brainwashing.
And I don't know what that says in another language. Is that Israeli? Yeah, I think so.
Yeah, that's Hebrew.
Can you read it, Kerry?
Can
No, but I know Hebrew. I think it said Shalom Aleichem, but I can't tell you for sure.
Jason, Coke or Pepsi? Neither one. I had this girlfriend years ago that stopped me drinking soda, and I'm very thankful that she told me not to drink that crap. It's terrible. I pretty much drink I drink a lot of water. That's a huge thing I'm in favor of is water. I'm a huge water fan. I actually like the taste of it, unlike some people. Yes, water is life. Okay, after oxygen, water is life, and then food is third. Okay, so I pretty much drink water and coffee and a little bit of vodka and occasionally a juice drink or something. But yeah, no soda for me. So quit that stuff. It's terrible for you. But take a penny and drop it in a glass of Coke and see what happens to it after like 24 hours.
Put it on the paint on a car.
You'll never drink it. Yeah, or put it on car paint, whatever. Okay, so seems like a lot of asset classes available to the regular Joe investor are in bubbles. At the same time, we seem to have a hyperinflation risk. How should one structure a portfolio for those seemingly opposite risks? That's a good question. Kerry, you want to address any of that? Naresh? I got my thoughts, but
look, my personal thing is I always believe in having a core holding of precious metals, physical, a small percentage, 10% assets. Maybe now it's a little higher. But the fact is, there really is no way to prepare for hyperinflation because you just have to look at the incidences where it's happened, and nothing's ever the same after. It takes years, sometimes decades to recover from it. So it's possible, but we haven't had a case of reserve currency hyperinflating in a while. Back to Rome, I guess, or Byzantine Empire.
I don't think a reserve currency's ever had a hyperinflation problem that I know of.
No, but we could be in a high inflation.
Yeah, we could definitely have high inflation, and I say the best asset for that is income property with good fixed rate mortgages against it. Okay, not income property that's free and clear. I mean, that'll hedge inflation, but if you really want to knock it out of the park in an inflationary environment, you got to have the debt, because the debt gives you the inflation-induced debt destruction, where you pay that debt back in forever cheaper dollars as the property goes up in value at the same time. Multi-dimensional, beautiful asset class. Naresh, any thoughts on that?
Yeah, I was going to say that real estate, really the point of this webinar, is the best hedge against hyperinflation, but also just stay diversified. If you want to put some in stocks, high dividend stocks, if you want to buy crypto, if you want to buy gold, physical gold, GLD, the paper asset, just be diversified. Don't put all your eggs into real estate. Don't put it all in, Bitcoin. Don't put it all in any one thing. Just stay diversified. And but I think the best hedge is definitely the real estate, and you got cash flow on top of that, so you can't go wrong.
Yeah, and those rents adjust for inflation pretty nicely too. So good stuff. Okay, so here's one. Oh, this is a good comment from Peter. Clocks are digital now. A stop clock just blinks 12 now and is always wrong. Good comment. Good comment. Okay. So what do you think about silver? Well, hey, Kerry, we had, it was Kerry's birthday last week, so I took him out for dinner, and he was talking about how silver, if it breaks $20, and then it did. So
it hit 26.
Oh, it went up to 26. Wow.
26 last night. Somebody texted me, one of my listeners, Brian, texted me, said $26. I missed it. Didn't stay there long. But I was saying for quite a while that if gold hit 1750, silver would begin its ascendancy. Gold's trading at record levels. Silver's trading at 50% of its record, which was set in 1979. So I like silver. I like pure silver miners. They've had huge run-ups. Might be a good time to wait for a pullback. There's going to be one at some point. Nothing ever goes straight up, but I'm a big silver fan, and I think there's really great opportunities. And just don't put all your eggs in one basket, and don't invest all at once, because you either want to average up or you want to average down. But if you put everything in at once, then you're making a bet that your timing is exactly right. And I can speak from that one, from bitter experience. It seldom ever works out that way.
Yeah. I don't like the metals because they don't offer income or tax benefits, but I have
agree.
A little bit of it, but
I agree.
It's okay. So where is everyone here invested in? I'm not sure if you mean asset class or location. I'm income property is my favorite thing. So I have properties in Florida, Tennessee, where else? Indianapolis, or Indiana, I should say, Missouri, quite a few places, and some others, I think, too, that I can't think of. Alabama also, yes, Alabama. And so I like properties, obviously the best, but, I have a little bit of precious metals and a little bit of stocks that I just wanted to park some money in, and I do hard money lending as well, and then businesses. So Naresh and Kerry. Naresh, you've been buying a lot of properties. Congratulations. And you're a young guy, and you've been...
Yeah, I love it. I want to buy more. Yeah, so I'm invested in... Well, yeah, as far as the question goes, I thought maybe he was asking the other attendees, but...
Maybe in the thread, yeah.
Yeah. But me personally, I'm a fan of real estate, and most of my investments are in stocks or real estate. So I own in Florida, Mississippi, Tennessee.
Yeah.
And one more, two different areas in Mississippi. So,
Right.
yep, those are all the places.
Good stuff. So, will prices drop in Salt Lake City area? 1,700 square foot is about $400,000, which is almost doubled from 2012. You know, Salt Lake City is a hybrid market. So we talked about the three types of markets: linear, cyclical, and hybrid. Salt Lake City is hybrid, and Salt Lake City is a good quality city. You know, I thought of moving there many times myself, but it's just too cold for me. I don't like cold. I tend to always stay in warm places. You know, but there's a lot of very intelligent people in Salt Lake City. You know, the Places Rated Almanac in the year 2000, now that was 20 years ago, rated Salt Lake City the best place to live in America. I think it's a really good place. I like Salt Lake City, but that doesn't mean it's not a bubble, okay? So 1,700 square foot for $400,000, you're over $200 per square foot. I don't know what type of property you're talking about, what area, what age the property is. Salt Lake City would not be an area I would be interested in investing in. You know, it could be okay if you just own your own home there, and it's, you know, you're going to own something probably. So that, you know, $400,000 isn't out of whack. But it's a great deal to rent a high-end property to live in yourself, and own a lot of low-end properties you rent to other people. That's a great arbitrage strategy. You know, Salt Lake is a pretty good city. You know, if it's doubled in 8 years, you're probably looking at a somewhat of a bubbly environment there. And I think Kerry, from his presentation, he would have agreed. He would agree with that. Okay,
hey guys, so, I actually I got to run.
Go ahead. Oh, you got to run. Okay.
Yeah,
Naresh has got to run. He's got a new baby. So bye, Naresh.
All right, guys.
Thanks for joining us.
And if anyone wants to reach out, feel free to contact us through jasonhartman.com.
Okay. Naresh, I will talk to you tomorrow, I'm sure, and I'll see you Friday. Okay, so I'm going to try to just...
Also.
Okay, bye, Kerry.
Bye, Jason. Thank
you for the bubble presentation. That was awesome.
Great. Yeah. Take care.
Yep. Take care.
Bye all.
Okay, so I'm going to try to zap through a couple of these last questions and go to bed myself. You know, I am an early sleeper. I go to bed at like, you know, 9:30 every night, so it's bedtime. Okay, so Henry accepted an offer and ready to sign on a house in Lake Placid, New York, for a 2-family home with tenants in place. Total rent comes to $2,200. Monthly overhead is $1,800. Rent to value ratio 0.65. Henry, I want to see a better rent to value ratio than that. What you did not say is how much is that property? How much is it? Not how much is the overhead. And the reason I don't like that metric is I don't know what your mortgage is. I don't know how much you put down on that property. I don't know how much money you have tied up in that property, right? So monthly overhead, that's not meaningful to me. What's meaningful is how much did you pay for the house and how much can you rent the house for, or the duplex in this case. So you did indicate that in the rent to value ratio, but I can't do the math off the top of my head here. So I'm not super excited about that deal. If there's an appreciation play there, or you can raise the rents, I think you'll be okay. It's certainly not the worst deal. It's just not the best either. Okay. So that's my opinion on that one. Okay, so here is David. David's one of our clients. He was on the last live stream with his lovely wife, Gina. Comment: if anyone is on the bubble about investing now, we are locked in a 3.5%. Congratulations. That is free money. Okay, including 1 point last week on a duplex in Palm Coast. That's here in Florida. Okay, totally worth it. Never thought I'd see that. You know, David, simply, like I think we talked about this on Sunday when you were on the other live stream with us, and thank you for joining us. If you never rent that property out, just borrowing that money at 3.5% is either you're getting free money or you're getting paid to borrow. The math is simple. If the Fed says the target rate inflation rate is 2%, okay? And if you've got a tax deductible mortgage there, which of course you do because you can deduct the interest, and everybody's tax bracket's a little different, depends where you live. But I know you live in Northern California, so I know you pay a lot in taxes, okay, state and federal combined. You're basically getting that money for free because at 2% inflation, and that's a low estimate compared to the real inflation rate, versus that and your tax benefit, which will equal about 1.5%, okay, about 40% of the 3.5% interest you're paying, roughly. That loan is free. The money is free. It's free to borrow the money. Now, if the inflation rate is higher than the target rate of 2%, you are getting paid to borrow the money if you never, ever rent the house. Okay, but of course you're going to rent it and you're going to get income and you're going to let the tenants pay the debt. So that is a phenomenal, phenomenal deal. Congratulations. That's awesome. Awesome deal. Okay. Okay, so the gold color says evening. Let's see here. What are your thoughts on North Central San Antonio, Texas? I need to move. Oh, that's where I also own property. I also own property in San Antonio. Thank you for reminding me. I can't even remember. And I have property in Austin too. So I can't even remember where I own properties anymore. And you're obviously a cryptocurrency fan by your name, Cryptorama. So San Antonio's a fine market. The only thing about Texas, and by the way, we've helped hundreds, maybe thousands of people buy property in Texas, in the major Texas cities over the years. Houston, San Antonio, Dallas, Austin. And San Antonio is good. I own property there. I've had property there since maybe 2005, 2004, 2005, something like that. And that's a good market. The only thing is those markets have appreciated a bit, making the rent to value ratios not so good anymore. So we don't really, we're not really active in any of these Texas markets anymore because the prices have gone up too much. And we actually don't like that because we want better rent to value ratios. And also in Texas, of course, you have what? You have high property taxes. So when the property taxes are high, that does impact your cash flow. But still, I'm bullish overall on Texas, but the deals are hard to come by. So, and did this relate to one of the prior? I think it did. 325,000. Oh, yeah, that was the... I think that was Lake Placid or something, right? So, wow. I can only say applause on the interest rate. 2.5%, that is nothing short of phenomenal. You are getting paid to borrow the money. So that might make up for your somewhat less than desirable rent to value ratio. So congratulations, that's great. Okay, so Cryptorama says, nice. Thank you for the content, Mario. Yeah, my pleasure. Please listen to the podcast and the YouTube channel. By the way, I'll say one more time, promo code for our Meet the Masters if you want to go grab tickets for that and join us for the entire weekend. Friday night, we're starting off with happy hour, cash flow cocktail. That's what we're going to have together. Friday evening, we're going to have a cash flow cocktail. And then we will have some good presenters on Friday evening. All day Saturday and Sunday this weekend, virtual event, jasonhartman.com/masters. And that promo code is JHLive. JHLive. Okay. Hey, Jason, glad to catch you live. Is there a property tax to rent income ratio sweet spot? A property tax? That's a question I've never had. No, there isn't. I don't have a metric for that one. Sorry, don't have a metric for that one. Do you think I should sell? Well, I don't know how much that property in Maine is worth. Maine is like a beautiful but obviously out of the way place, right? So that is not a market where there is a lot of action. Okay, the action is mostly in the southeastern United States. 10,000 people a day turn 65 years old in this country, and those people generally go south. Okay, when they retire, They want a lower cost of living. They want a beautiful environment. They want low taxes, less government intervention. These are where the right to work states are. The labor unions, thankfully, are losing power, and these are the business-friendly places. So the action is in the southeastern United States, and that's where you want to focus. There are a few exceptions. Go look at the properties we have at jasonhartman.com in the properties section, okay? So that's it. Okay, and what are your thoughts on investing in single family in Ocala, Florida? Ocala, Florida is one of our markets. We love Ocala. That's a great market. A lot of our clients have been buying there, and Ocala is fantastic. And we've got some great team members there. They'll be presenting this weekend, actually, at our event, our virtual event on Zoom, jasonhartman.com/masters. And we're big fans of Ocala. So feel free to contact us, and we'll be happy to help you with that if you're not already working with us, which you might be, I'm not sure. Okay, so what is your input on banking velocity to pay down a mortgage right now? I don't know what you mean by banking velocity. That's an interesting way to say that. I don't know what that means, but I definitely believe that inflation pays down your mortgage for you, and that's one of the beautiful, beautiful things. So that's called inflation-induced debt destruction. I've been teaching that for many, many years, and it is a fantastic, fantastic thing. If you want to know more about that, check out my YouTube videos on inflation-induced debt destruction, or better yet, to get a more detailed explanation, just go to jasonhartman.com, and in the search bar on the website in the upper right, type in that phrase, inflation-induced debt destruction. I know it's a mouthful, but it's an easy way to remember it. And go ahead and check out the full detailed podcast on that. And I think you'll get a lot more information about that. Okay. So Jessica, thank you for making valuable videos. Is velocity banking using credit cards a good method to pay? This term velocity banking is a new one to me. I haven't heard that before. So I don't know. But no, I would not use credit cards to pay off a mortgage. I would keep the mortgage for as long as you can keep it. Paying off a mortgage is a bad deal, folks. Don't pay off your mortgages unless there's some ridiculously high interest rate. Mortgage money is cheap. You want to keep that debt. That is good debt. Okay, look, as I've said before, debt is my favorite four-letter word. I say that, of course, somewhat sarcastically, but good debt is a good thing, okay? So inflation-induced debt destruction is excellent for paying off your debts, and those cheap mortgages are good. Keep those cheap mortgages. Keep them. Okay? Don't pay them off. Cheap mortgages are a wonderful thing. All right, folks, I'm going to wrap it up and say goodnight myself. I see some of you in your comments are saying goodnight, so I probably should be saying goodnight too. It's almost 10 o'clock here, and that's late, and I got to go to bed too. So our 22nd anniversary Meet the Masters is this weekend. jasonhartman.com/masters. Promo code will work for 1 hour after this, 1 hour, and it is JH Live. Do that at checkout. You'll get $100 off for the next hour. And thank you all for joining us. Happy investing to everybody. I'll be on the podcast tomorrow, and really appreciate you joining us, and appreciate the great questions and comments. So thank you for your participation as well. And good night and happy investing.